Everyone agrees on one piece of financial advice more than any other: save your money. It's printed on greeting cards, repeated by grandparents, built into every piece of advice from every financial guru on the internet. Nobody ever got publicly shamed for having a savings account. And that near-total agreement is exactly why almost nobody questions what happens to that money once it's actually sitting there. Here's the twist: for tens of millions of Americans right now, the act of saving, done the way most people do it, is steadily making them poorer every single year. Not because saving is bad. Because cash, sitting still, is not neutral. It's not safe in the way it feels safe. By the end of this video, you'll understand exactly why a growing bank balance can represent a shrinking fortune, why the specific psychology that makes cash feel safe is the same psychology that's costing people real money right now, and exactly where the line sits between saving that protects you and saving that quietly works against you. Start with the feeling itself, because it's not irrational, it's just incomplete. Decades of research in behavioral economics has established that losses hurt roughly twice as much, psychologically, as equivalent gains feel good. That single asymmetry, known as loss aversion, shapes an enormous amount of financial behavior. A stock portfolio can drop 10% in a bad month, and that loss registers as a real, visible, immediate pain, the kind that makes people check their phone at 2 a.m. during a market sell-off. A savings account, by contrast, never drops. The number on the screen only ever goes up, one small deposit or interest payment at a time. Of course it feels safer. It's specifically designed, psychologically speaking, to never trigger the loss aversion alarm at all, because the mechanism that alarm depends on, a visible number going down, simply never fires. The problem is that never going down and never losing value are two completely different claims, and human brains are exceptionally bad at telling them apart. That gap has an actual name in economics: money illusion, first described nearly a century ago and later confirmed through controlled research at Princeton. It's the tendency to evaluate money in nominal terms, the number printed on the statement, rather than real terms, what that number can actually buy. In one well-known version of this research, people were asked to judge two scenarios: an employee who receives a 2% pay cut during a year of zero inflation, and an employee who receives a 2% pay raise during a year of 4% inflation. Mathematically, the two scenarios leave the employee in almost exactly the same real position. Their actual purchasing power falls by roughly the same amount either way. Most people judge the pay cut as far more unfair. The raise, even though it left the employee no better off in real terms, simply felt like good news, because the number on the paycheck went up instead of down. Apply that same illusion to a bank balance and the pattern repeats exactly. People will treat a balance that grew from $10,000 to $10,200 as a win, without automatically checking whether prices grew even faster over the same stretch. The illusion isn't stupidity. It's a mental shortcut that worked fine for most of human history, when prices barely moved year to year, and it simply hasn't caught up to a modern economy where they do. Put loss aversion and money illusion together, and you get a surprisingly durable trap. Loss aversion makes a static number feel safe because it never visibly falls. Money illusion makes that same static number feel like progress, because it keeps rising in nominal terms. Two separate, well-documented mental shortcuts, pointing in the exact same direction, both steering people toward the one asset that's guaranteed to lose real value over time, and both doing it so smoothly that it never once feels like a decision being made. Here's what that illusion is hiding right now, in plain numbers. The national average savings account in the United States pays somewhere between 0.4 and 0.6% annually. Several of the largest banks in the country, the names everyone recognizes, pay as little as 1/100%, effectively nothing. Meanwhile, inflation has been running close to 3% a year. Subtract one from the other, and the national average saver isn't standing still. They're losing roughly 2.5% of their money's real value every single year, while watching a balance that only ever ticks upward. Picture two savers, each keeping $100,000 in cash, a completely reasonable amount for someone mid-career with a paid-off emergency fund and some extra cushion. The first keeps it in a standard account at a major national bank, paying 1/100%. After a year, that account has earned about $10. The second keeps the identical $100,000 in a competitive high-yield account paying 3%. That account has earned $3,000 over the same 12 months, on the exact same starting balance, with the exact same federal insurance protecting every dollar of it. Neither saver took on any additional risk. Neither one made an investment in the traditional sense. One of them simply filled out a form. The Bureau of Labor Statistics' own inflation calculator makes the deeper cost concrete. $20 spent on ordinary goods and services in 2019 required a little over $25 to buy the same goods and services by 2025. Anyone who kept that $20 in cash instead didn't preserve it. They watched roughly a fifth of it simply evaporate, without a single transaction ever taking place. Scale that up and the number gets genuinely staggering. American households are currently holding somewhere in the neighborhood of $14.5 trillion in checking accounts, savings accounts, and similar deposits. A meaningful share of that sits in accounts paying at or near zero. On an account balance many households would consider completely reasonable, the gap between a typical big bank savings account and a competitive high-yield alternative can run into hundreds of dollars a year in earnings left unclaimed, before inflation even enters the picture, and thousands more once it does. None of that money was stolen. None of it was mismanaged in the traditional sense. It was simply left in the one place specifically engineered to feel safe while steadily losing a race against prices that never stops running. Something interesting has started happening as more people notice this. Over the past 2 years, Americans have pulled more than $1 trillion out of low-yield checking and savings accounts and moved it into money market funds and brokerage cash accounts paying meaningfully more. Total money market fund assets crossed $7 trillion in early 2026, up from under $6 trillion just 2 years earlier. That migration isn't a niche trend followed by financial obsessives. It's one of the largest shifts in household cash management in recent memory, and it's happening precisely because enough people finally ran the math on their own safe account and didn't like the answer. Surveys suggest roughly a third of Americans currently have a savings account paying at least 4%, which means, by the same math, that roughly 2/3 still don't, and are absorbing this loss right now, in real time, without necessarily knowing it's happening. Why did it take this long? Because the entire cultural script around saving was written for a world where money illusion didn't cost much. For most of the 20th century, prices moved slowly enough that a dollar sitting in a drawer or a passbook account lost value at a pace nobody could feel year to year. The advice "just save your money" was genuinely close to sufficient advice on its own. Grandparents who lived through eras of extreme scarcity absorbed a simple, sturdy belief: money that's spent is gone, and money that's kept is safe. That belief made complete sense in the world that produced it. It just never got updated for a world where inflation runs as a permanent, structural feature of the economy rather than an occasional emergency, and it got passed down anyway, unchanged, the way most financial beliefs travel between generations. Layer identity on top of that inherited belief and the resistance to updating it gets even stronger. Saving carries moral weight in a way spending simply doesn't. A saver is disciplined, responsible, prudent. A spender, or worse, an investor watching a portfolio dip, looks reckless by comparison, even when the numbers say otherwise. Nobody gets complimented at a family dinner for their aggressive asset allocation. Plenty of people get warmly admired for having a good amount put away, regardless of what that money is actually doing while it sits there. The behavior that feels the most virtuous and the behavior that actually protects your money over time have quietly drifted apart, and almost nobody sends out an announcement when that happens. None of this means saving is the villain. It's the opposite. Saving is still the entire foundation of a stable financial life. The mistake isn't saving money. It's treating every dollar you save as if it belongs in the exact same type of account, regardless of what that money is actually for. The people most exposed to this particular mistake aren't reckless spenders either. Federal survey data consistently shows that Americans in their late 60s and early 70s hold some of the largest cash balances of any age group, often well over $100,000 sitting in checking, savings, and money market accounts combined. These are frequently the most disciplined savers in the entire population, people who spent decades doing exactly what they were told. And because that money is often sitting in whatever account it landed in years or decades ago, it's frequently the group losing the most in absolute dollar terms to an illusion that never once felt like a mistake while it was happening. Money you might need in the next few months, a true emergency fund, genuinely belongs somewhere safe and liquid. But safe and liquid and earning close to nothing are not the same requirement, and treating them as identical is where the real cost hides. A high-yield savings account offers the same federal insurance, the same instant access, and, depending on current rates, a yield several times higher than the account most people default into simply because it's the one their bank opened for them automatically. Money you won't need for years, the kind that's been sitting in a regular savings account just in case for a decade, is a completely different conversation. That money isn't being protected from risk. It's being guaranteed to lose value, slowly and predictably, to a force that never takes a year off. For money on that kind of timeline, understanding your actual, inflation-adjusted return matters more than the comfort of watching a static number never go down. Practically, that starts with checking the specific rate your specific accounts pay today, since most people genuinely don't know it and assume it's higher than it is. Log into whatever app holds your savings and find the actual annual percentage yield in writing. For a large share of people watching this, that number will be uncomfortably close to zero, sitting in an account that was opened automatically the day a checking account was opened, years ago, and never once revisited since. From there, match each pool of money to its actual purpose instead of treating all savings as one undifferentiated pile. A genuine emergency fund, 3 to 6 months of essential expenses, belongs somewhere that combines instant access with a competitive yield, which today means a high-yield savings account rather than the default option most banks steer new customers toward. Moving that fund costs nothing, takes minutes online, and doesn't sacrifice a single bit of the safety or liquidity the emergency fund exists to provide. Money earmarked for a specific goal a year or two out, a house down payment, a wedding, a planned move, can often do better in a short-term certificate of deposit or a money market fund, locking in a known rate for a known period without the volatility of the stock market. Laddering several CDS with staggered maturity dates can capture a competitive rate while still leaving a portion of the money accessible every few months, rather than locking the entire balance away at once. For savers specifically worried about inflation eating into government-backed savings, Treasury inflation-protected securities and inflation-linked savings bonds exist for exactly this purpose, adjusting their value directly against the same inflation number that's been steadily working against a standard savings account. And money that's been sitting untouched for years with no specific near-term purpose, the kind that's grown into a large, comfortable-looking balance simply because nobody ever moved it, deserves an honest conversation about whether it should be doing more. That doesn't necessarily mean the stock market, and it doesn't mean abandoning caution. It means recognizing that doing nothing is not actually a neutral, risk-free choice for that money. It's a choice with a cost, paid silently, every single year, to a force that never announces itself the way a market crash does. None of this is a call to abandon caution, and none of it is personalized advice for your specific situation. It's a call to point that same caution at the risk that's actually the largest for most long-term savers, not the market's occasional bad year, but inflation's constant, unglamorous, undefeated one. Because the right mix depends heavily on your own timeline, goals, tax situation, and risk tolerance, this is exactly the kind of decision worth running past a real financial professional rather than a general rule from a video. The lie was never that saving matters. Saving matters enormously, probably more than any other single financial habit most people will ever build. The lie was letting one word, safe, describe both a true emergency fund and a decade of idle cash losing a quiet, guaranteed war against inflation. Cash isn't the enemy here. Standing still is. Once you can tell those two apart, saving stops being an act of faith in a number that only ever goes up, and starts being what it was always supposed to be, a decision, made on purpose, about where your money actually works hardest for you. That's not a smaller or riskier version of saving. It's the same discipline your grandparents taught you, finally pointed at the century it's actually operating in.